very much for all joining us on this panel today. And first of all, I like to do it to startup, scale-up company heads. Sum up what your business does in just a minute for us first, because Jane, of course, you're coming for us. You were at Yandex Money, now heading up Yandex Data Factory as well.
Yeah, actually, I kind of know both of these worlds, financial services, because Yandex Money is electronic wallet system of Russia with tens of thousands of customers. And in my current role, I'm CEO of Yandex Data Factory, which brings innovation into industries based on new machine learning technologies. And
Kristo, while the beat keeps continuing, give us a sense of what you do.
So about 5 years ago, me and my co-founder figured out how to move money between countries without paying fees to the banks. So banks take about $300 billion every year from their customers for moving money around the world. We now move about, started from nothing, we now move about 700 million euros every month around the world.
And Hardeep, Motif Investing.
So Motif is a next-generation online broker where instead of picking individual stocks, you get to invest the way you think. I want to invest in drones. I want to invest in climate change. I want to invest in buying beaten-down stocks. We take these expressions, we make them actionable by turning them into a motif. So we're 4.5 years old. We're based in Silicon Valley, and we are just getting started with an international expansion. So we're pretty excited about taking the innovation we've done in the United States and taking that globally.
So you put the three of you together, and piece by piece, we are clawing away at what the banks currently have been providing. We've got payments, we've got FX, we've got investment. Hardeep, kick it off for us. What is left of the banking industry by the time Silicon Valley has had their way with it, by the time, as Jamie Dimon said, Silicon Valley is coming? How are they bracing themselves?
Well, full disclosure, Jamie is an investor in our company, JP Morgan, Goldman Sachs. So I think for us, what's left of it is I think there's really three big things. I think a lot of the repetitive functions are going to go away through technology. We think there's a lot of value. We're not going to disrupt Wall Street, but Wall Street will change. And one of the big things we see is insight. It's really hard to develop insight. Now, there are a lot of people who say, yeah, there are passive investing models, but even on passive, it's predicated on costs, and costs are going to go to zero. And when costs go to zero, passive doesn't beat active, and who has insight? The second thing that's going to be left is it's very hard to replace human relationships. When it comes to money, people do want to talk to someone. They need a therapist, a coach to withstand the markets. And until we get real robots, there will be no automated. I think a lot of relationship will continue. And then the third big thing that we see is it's really hard to offer tailored financial advice. And the more complex your situation, software isn't there. I'm a software bigot. I think software will solve world hunger because it's a distribution problem. But when it actually comes to tailored financial advice, we're just not there yet, and it's going to take us a while. So we think insight, relationship, tailored financial advice, those are going to be strength areas for the big institutions.
Jane, you're shaking your head.
I disagree with 2 or 3 points. In fact, well, of course, insight is something we can take out of humans, at least not yet. Not for the next 10, 20 years, I think. Computers are not that good yet. Speaking about relations and human interaction, I strongly disagree. Because, in fact, what you expect from interaction with your financial advisor or your bank is to be taken care of personally. But how do you imagine taking care of your customers, which are millions, on the personal level? That's pretty much humanly impossible. But it is very much possible with machine learning technologies, which can personalize the experience. One more thing about this personalization and human interaction. Just earlier at MoneyX event, one guy from investment bank gives this example. He said, you know what? You may think that probably wealthy people, at least, because they are making big decisions, moving big money, they expect you to have this personal approach. But in fact, I have my biggest customers, trillions, no, he said billions, with billions of assets, who asked me exactly that. Can you do something so I don't need to speak to your people? Can you give me APIs, something I would work through? Because I didn't want that. And yeah, I can easily understand.
I couldn't disagree more. I think this whole notion of man versus machine is actually ridiculous. I think what's going to happen is it's going to be a debate between high tech and high touch. High-tech will be everywhere. Relationship people, everyone's going to be using high technology. The question is, when do I need to superimpose? What I do agree on is simple scenarios like millennials, where they put money, that can be automated. When you get to different, and when you're talking 20 years, I mean, who knows what's going to happen in 20 years. But today, you're seeing this transformation where the banks are investing heavily in technology, supporting their human infrastructure with tech. So tech will be everywhere, and for us, that's actually a good thing. The big debate is, when do you need people? And I will agree that there are certain scenarios where you don't. Small accounts can have an advisor now, and it's going to be automated through technology. But the baseline of where we are today is very much human-driven. And believe me, I wish it weren't the case. I came into this business thinking not. We decided pretty early on to partner with the large financial institutions because it will take a lot of effort before we go in and replace humans. And the big good news for everyone here is technology will win across the board. Humans will use it as advisors, so will young millennials that want to automate it. And I think technology wins whether or not you displace humans or not.
I think most of people much less romantic than that. What they value is personal touch, but not the actual person. They want to be offered something relevant.
Why do you hire an advisor? You hire it for someone to
my
walk
banking
you through
manager
and
can
manage the
forget
process
something to remind me something. Software cannot.
I think
Kristo,
it might be,
yeah.
actually it might be a cultural thing. So we have an American, a European, and kind of further to the Eastern Europe. I think Americans actually love the personal touch. You know, Europeans and I think further east you go, actually, we don't care. And I think the smarter banks have figured out that they're really technology companies. And they have kind of taken that approach that, you know, we build products, and you know, today we have people who sell products, but eventually in the future people will find how they use our products themselves. So the huge sales forces that we have in the branches, these are all going to fall away eventually. But I think it's an interesting question. 10 years in the future, do we ask what the banks are going to be? I'm not sure that we have the concept of a bank. I think some banks will become technology companies. Some banks will become credit agencies. Maybe some banks will become wallets. But I think the concept of a universal bank is unfortunately doomed, and it's going to be sliced into various different verticals. And
if regulation allows that sufficiently, because that's probably the biggest
regulation will demand
slowing down factor.
Regulation, they want to do that.
Talk to me about where you are being able to expand the most quickly in your businesses because of a regulatory environment that is hospitable to the disruption, and whereas inhospitable at the moment, Jane.
Yeah. Well, for Yandex Money, that was very simple. We had two things which allows us to start very quickly. One, yes, that's regulation. Basically, there was no one. I mean, there was no regulation for payments specifically, and we could kind of work. I still remember this first international auditors coming to us and making the audit of what we do. In their conclusions, there was this phrase about, well, doesn't directly contradict the current regulation. That was what we were doing, right? Because we were not contradicting, we were not actually doing something wrong, but it's not like it was right. Nobody knew what was that. That was the first thing which allows you to move quickly, to think about your product first and compliance second. And second thing was, we had this huge gap to cover. Because Yandex Money appeared in Russia in 2002. And back then in 2002, most of people in Russia, they didn't have bank accounts. They didn't have bank cards. They didn't have any other way to pay over the internet than the new one we introduced. And that's why it spread so quickly, because it was actually a great alternative. It's still spreading around now because we keep up with the speed of changes. Because, well, when you think about Yandex Money as kind of a Russian PayPal, you actually do not understand the whole scale of things, because it's not just electronic wallet you use for e-commerce. You can use the Yandex Money to pay your taxes, or your road fines, for example, or transfer money to your relatives. So that's something traditional banks are only starting to provide in Russia, well, sufficiently enough.
Kristo, do you agree that you could focus on the product first and the compliance second, or did you have to go into regions and think it's compliance first?
I think finance is the industry where you get licensed first, and then you take the product to the customers. That's what we did, and now being in 50 different countries, you know, that's the imperative. When we go to a new country, we get licensed first, and then open up to customers.
It's nice to start without that.
Exactly, and I think that's the reason why, really, since PayPal, I think there hasn't been a lot of global innovation happening because being a global company, which we unfortunately have to be because we're moving money around globally, it's quite hard. You have to kind of go into a market, get regulated locally, have a local presence, and then you can make a really global tech company.
Hardeep, you're entering new regions as of next year. Are these the ones that are most hospitable at the moment? Tell us where you're heading.
Yeah, I mean, I think for us, it's two things. Even as we go global, it affects our regulation in the US. And when we first started, I remember getting a letter from FINRA, the securities regulator, saying, congratulations, we've accepted your application, but we're putting you on the new and novel list. That was the worst news we could possibly get. And so for us, it is the reason companies take a long time. I spend 20% of my time, and this is no different than some of the larger companies, on regulatory issues. I joke with my board, they don't have my 5-year roadmap, our regulators do, because it takes, or some of the things we wanted to launch, it took 2 years to get regulatory approval. And so it's not just the big companies that struggle with regulation. One of the reasons, at least in the US, that you're seeing a lot more innovation is the regulators have moved from a rules-based methodology of regulation to principle-based. Had we launched our company a year before, they would have said no.
Clearly the 5-year plan is bullshit, right?
Well, no, it isn't. It isn't. Actually, we have to know that there's certain things that it's going to take the regulators 2-3 years to get their arms around. And as we go international, the first thing we do, right, is we sit down with regulators and say, do you understand what we're doing? If the answer is no, then let's explain it to you. And if the answer is like still no, we don't enter that market. And for now, there are enough markets that are saying yes to Motif that we'll tailor it. And right now, it's the UK, Hong Kong, and Australia. And everyone goes, why those markets? It's because we've had positive signs from the discussions there.
I mean, inspire the audience, the entrepreneurs who are busy coming up with their FinTech ideas and wondering how they can start to accelerate that process. Where first? What first then is, how do you start tackling what is a pretty difficult environment to scale within quickly?
I mean, in one sense, yes, it's a difficult environment, but on the other hand, the problem is so big and massive. So the 300 billion number that I quoted earlier, that's just for money transfer, and that's like number 10 on every bank's list of priorities.
Goldman Sachs thinks, what, $4.7 trillion is going to be the value of financial technology in the end?
Exactly. So the opportunity is so huge that for a starting entrepreneur, what you really need to do is to figure out what is the problem that you're starting to solve, whether it's investing or holding money, put a product out there and see how people start using it. And I can guarantee you can come up with a better product than your bank has.
But I think on the regulatory front, it is a huge source of competitive advantage to get in with the regulators, to work with them. In Silicon Valley, there are two types of startups, right, in the FinTech space. Folks that put their head in the sand and pray the regulators won't show up, and then they kind of drive innovation, and then if the regulators do come up, you could be in trouble. Or you gain more white hair. You can't see my white hair. But by engaging with the regulators, and I think it slows you down, but when you're making huge product decisions, huge business decisions, you can't afford 3 years in the regulator saying you can't do that. And so it is about engaging, and if you do that successfully, it becomes a source of competitive advantage that other startups come into the space. If they don't do it right, you've got a leg up against them.
Jane, of course, when there's on the one side the regulators you're talking to, but also you've got to be engaging with the consumers and building trust. How do you go from a small startup and build trust within your consumer base so that you can start to ramp up quickly?
Yeah, well, that's exactly where paradox lies, and that's what brings me to the question of the future of the traditional banking industry. Because the only way to make sure that consumers love you, the consumer trusts you, and they want to stay with you, is to put consumers' interests first and everything else second. On the other hand, being a licensed institution, you cannot do that. You do put compliance first. That, just as my colleagues explained, which actually may lead to a strange situation. And I believe that the reason why we have so many FinTech innovations around, and small FinTech companies, is exactly as what's said now. They can experiment and hope that regulator doesn't see before they are bought by some bigger institution. But at some stage, we may come to the point where the data-based, the technology-based companies are so much better in tackling this user experience thing that users actually do prefer to interact with them, not with banks. And in this case, what is left for banks is to be an utility with a license. So they sit in their safe pond, being protected by regulation, and not taking care of much of innovation just because they don't really need to. On the other hand, there are all those new guys growing, and that's actually a good question. Because, for example, in some other industries, well, let's say automotive industry already says that they consider Google as a competitor. BMW says that, right? Online travel agencies and Amadeus, they also see some problem in this. Because you have all the data, you know how to tackle user experience, you make sure that you provide the best possible advice, the best possible care based on your algorithms. Well, the only thing you lack is license, but we have so many licensed institutions out there. They can work as utilities.
Transfer-wise, how are you finding the banks reacting to you? You've just reduced all their fees from foreign currency. You're pushing down from your base. You're giving a great consumer experience. Are they going to want to buy you back? Are they building up their own ways of tackling you?
So unfortunately, I feel for the banks, right? So they have
your heart bleeds.
We all do.
I mean, come on, our life is easy here. We're in the kind of the peak of what's cool. You know, they have huge problems on their hands, and as I said, TransferWise is number 10
and
probably on their
work
on their list. So no, and actually, in fact, some banks have told us that they recommend TransferWise to their customers because, in fact, we can provide a better service, a better product. So I think, like coming back to your earlier question, you know, how do you scale? I think eventually better product wins. And what's interesting is that banking has always been a very local business. There have been only a couple of brands like Citibank and HSBC that have been truly global. But the retail banking has always been a local thing. But you know, in the modern world, we think Google is everywhere, like Facebook is everywhere, Twitter is everywhere. The interesting question to the regulators and us as users is, you know, what if we're going to have bank brands that are suddenly going to be everywhere, hopefully coming out of the kind of the tech scene?
Are banks, of course, you've got them as your investor base. Are they recommending you now? Are you finding that's the way that you're actually managing to scale?
So I think we scale two ways. One is we do have exclusive partnerships. For example, last week we announced that if you want to participate in pre-IPO stock, we've partnered with JP Morgan exclusively, that they'll be distributed through our platform. So we've got strategic partnerships like that. But a lot of what it takes to grow your customers is to actually have them help you. So it took us a year to build 100 of these motifs. We have these PhDs in computational finance that do that. And our customers said, you know, we can build it. I may not know anything about investing in general, but I'm an expert in minimally invasive surgery. Let us build it. And during the time it took our PhDs a year to build 100, our customers built 85,000 of these products. They're now 180,000 motifs. And you're going to see a lot of interesting partnerships around things like data. We have an Obamacare motif, for example. We can tell you what rich, young, poor, old, what Democrats, Republicans really think about Obamacare in the United States, based on data. And it is these new partnerships, these abilities to actually share data from all this model that's actually going to be where all the value ultimately migrates. So we will strategically partner in areas where we think, you know, banks are driving underwriting. We want to help them. They want to help us. But to your point, it is about the product experience. It is an advantage that, you know, what we can do with a few engineers versus big institutions can't do with hundreds of engineers. That's going to continue to be the source of strength for companies like ours.
How do you make the customer comfortable with the fact that you're embracing their data, using their data, and taking value from it?
Well, that's very easy. When people feel taken care of, they're happy. And that's pretty much it, because more and more people interact with their financial services, well, in some decent way, right? We use mobile apps, we use web banking, and we don't really know who's there on the other side. Is it human, or is it robot, or is it algorithm? And in fact, very often, probably you also have this experience, you just write to some customer support and you get this standard reply and you feel like, okay, is it robot sending it to me? It's probably human, because robot would do better. So that's actually my point. Very often, implementing those new, well, machine learning, you can call it artificial intelligence-based technologies, you provide so much better care, people actually feel like being humanly taken care of.
Kristo.
Pay your customers. That's the best way to solve the data. Pay them, and they will give you permission to use their data.
You can pay them with the quality of service. They are happy to share their data. knowing that they
happier.
receive
That's what we
some
do.
good service in exchange.
Well, it's the service. I think it is the service that matters. And I was actually, the most fascinating story of my life was, I think, the day that when we put TransferWise live, there's a blog post on TechCrunch that 2 Estonian dudes create this website where you can kind of send money. And you know, like 15 minutes later, there's some dude who put £2,000 onto the website to send it to France. And then, you know, 5 minutes later, there's euros arriving. I would have never thought that people trust just a website, but they do. And that's amazing, because people are starting to realize that the fact that you have bank branches all around the street doesn't make you any better at managing your, well, in our case, your money.
Exactly.
Right?
And it brings me to analogy. Back then, in early 2000s or even end of 1990s, when internet just started to appear, you know, there were the guys, internet service providers, and they were thinking they are internet. Actually, they were owning the internet resources, creating search engines and web portals, and where are they now? Right? They are licensed institutions which provide some utility, and the real internet companies are totally different type of companies from that. So we may end up in this situation when the traditional banking stays there, just as internet service provider. Some low margin, very safe business, nothing exciting. Or they may try and learn from FinTech companies.
And in that respect, where have the banks still got to salvage? Where is yet to be disrupted? If you weren't doing investment with Motif, where would you be looking?
I think for me, I think there are a lot of areas. It's actually outside of everything. I think the whole notion of a mutual fund is an antiquated product. It's where most people's money is. And what you're going to see is kind of what I call the Dell direct model of investing. I have an insight, and I want to deliver it direct to consumer. We did this partnership with Pacific Life, where they create insights, and instead of delivering them through a mutual fund, they go direct to consumer on social media, bypassing this expensive sales infrastructure, this expensive fund infrastructure, and go direct. So imagine a world where fund fees go to zero. And I think that is the biggest thing. You know, I think in the last crisis, financial crisis, Americans lost $8 trillion. $8 trillion. That was sad enough. The punchline was they had to pay $376 billion in fund fees for the privilege. That isn't the American way, and I think there's a lot of opportunity to go right that wrong there.
If it wasn't FX?
Yeah, it was probably a message to all the VCs, right? The fund fees are, are a bit of overkill. But if it wasn't for FX, I think, so the way that I look at banking, there's those very quick products like payments. And we find that these get disrupted the earliest. So payments, you only trust your bank for a couple of days, right? And on the other spectrum, there are things like mortgages and insurance. So I find that when you ask where is the stronghold for banks, I think that's where it is. These are the kind of the long-term products. Although I just noticed in London, we used to be part of an accelerator called SeedScam. I think there were 16 companies in their class of this year that were tackling mortgages or real estate around it. So I think what we're seeing is, okay, payments are getting solved slowly, and we're entering this kind of the longer term loans, mortgages business, and eventually I think the hardest part is insurance, and then, well, investments as well, being quite long term.
And Jane, for you, if it wasn't the payments area, where looks exciting, certainly when you're looking at Yannick's data factory as well, which area of the bank are you after next?
Well, there are some obvious parts. Actually, I very much agree with my colleague that there are parts of business in the bank which are very long-term. And long-term businesses are not very good for this kind of automation, for machine learning automation. Because machine learning, it doesn't explain anything and doesn't provide you with strategy. And it's just vice versa. If you know exactly what you want to improve, you know exactly what the KPIs you want to work on, it can provide you with recipes, and you need to be able to experiment quickly and check that it actually works. And if you can experiment within, like, say, 2 years or 10 years, it doesn't work that good. Which basically means that everybody will be replaced by the machines except for those who are responsible for long-term things. For example, if you're responsible for strategy, well, probably machine learning algorithms will not replace you very soon. But if you do something quicker, marketing, all kinds of marketing and sales efforts in bank, they are getting automated now very, very quickly. All this time, customer support. Again, the more we automate it, the better and more human it becomes. In risks, here it already comes tricky, because when we talk about, for example, POS loans, when you just fund some purchase, well, it's a short one, and it can be automated, but mortgages, probably not.
I want to thank you for your lively debate. I want to thank you for whetting the appetite of the audience. I hope they're all going to go away and decide which bit of the bank they might be focusing on now, show a little bit of competition out there. And please, audience, please give it up for a fantastic panel. Of course, Hardeep from Motive Investing, Kristo from TransferWise, and Jane from Yandex Money.
Thank you.